You guys have the best podcast of all. I drive a 2017 Toyota Tacoma, and my beverage of choice is a good bourbon. On to the business. My husband and I filed taxes separately due to student loan repayments. As a result, we cannot start a Roth IRA. So the question is, if your IRS filing status is married filing separately, do the same rule applies to the Backdoor Roth contributions? Thanks for educating and entertaining. And thanks for your spitball, Jim.
Best podcast of all, Alan.
That was very nice.
Jim didn't actually say YMYW, so he might have sent this to everybody.
Good point. Yeah. Good point.
Just a blanket voicemail to every single financial podcast out there.
Right.
All right. So he wants to do a backdoor. So married filing separately, the Roth conversion rules and contribution rules are a little bit different than single and married. But can he do the backdoor?
Yeah, single, the phase out starts at 129,000, and for married filing separate, the phase out starts at 0 and completely phases out at $10,000. So most people married filing separate cannot do a Roth contribution, at least in the normal way. But then the question is backdoor Roth, right? Backdoor Roth is when you make a IRA contribution, generally non-deductible. It could be deductible, but generally non-deductible. And then after that, you go ahead and convert that amount, and you don't pay tax because you didn't get a tax deduction. Those same rules apply to a married filing separate. It's just that you have to do it at 10,000 of income, or instead of like 214,000 of income.
So he could do an IRA contribution for sure.
That's what I'm saying.
Yeah, married filing separately. So you make the IRA contribution, and then you go ahead and convert the IRA contribution into a Roth, because there is no adjusted gross income limitations on a conversion. There's only adjusted gross income limitations on the contributions. The only thing that Jim needs to be wary of is the pro rata rules and the aggregation rules.
Correct.
And I don't really think those. I mean, who cares? If you're only doing $6,000-$7,000, I mean, the pro rata aggregation rules, the tax is not going to be that big anyway. And let's say he doesn't. It's a full deductible contribution, and then they're like, oh well, I can't do the backdoor because I got the deduction, and if I convert it, I have to pay tax. Well, if you did a straight contribution, you pay tax because it's an after-tax contribution. It's the same. If you make a Roth IRA contribution, it's an after-tax contribution. So you already pay tax on those dollars from your paycheck, and then you take those dollars and you put it into a Roth IRA, and all of those dollars will grow 100% tax-free. Let's say, but I don't qualify. The best thing about, all right, if you don't qualify for the contribution because you make too much money, then that's when the backdoor makes sense. It's like, okay, but I don't care about the pro rata and aggregation rules in regards if you're only doing a $7,000 conversion, right? But if you have a lot of bases, let's say that you've made a ton of after-tax contributions into an IRA over the years, and then you convert those dollars, then the aggregation of pro rata rules really come into effect, because that could blow you up. Because we've seen people that have maybe $50,000 of non-deductible contributions over many, many years. And then they try to segregate that IRA and say, well, these are after tax. I'm going to convert this $50,000 and not pay any tax at all to get the 50 grand into the Roth. Well, no, you have to take the 50,000 of after tax and add it up to all of your IRAs. So that's the aggregation rules, right? So you aggregate all of your IRAs, just yours. If you're married, it's not you and your spouse. It's just yours. Individual retirement accounts, IRAs, it's all individual. So then you look at the pro rata, and then you just divide what your basis is into the total aggregate amount will determine what is your tax-free portion of that overall conversion. But if you're just converting $5,000, $6,000, $7,000, $10,000, I mean, I think the benefits far outweigh a little bit of the tax that you will pay, depending, of course, your overall situation, to have compound tax-free growth for life.
So at any rate, if you do an IRA contribution and you're not able to deduct it, and you don't have other IRAs, you can then convert that amount and pay no tax. And that's the concept of the backdoor Roth. If you have other IRAs, it gets more complicated. But what Joe is saying is, don't worry so much about it. Just getting money to a Roth is a good deal for most people.
Yeah. The only thing that it might be a surprise where you think it's going to be a full tax-free, conversion, because you hear backdoor, right? So you did the backdoor, but you didn't, you had other IRAs. So you have to follow the aggregation pro rata rules. So.
Are you prepared for retirement? Schedule a free financial assessment with an experienced financial professional right online at purefinancial.com.